All right, ladies and gentlemen, welcome to this session of Built to Sell, Exit Ready or Just Tired. If you own a business, this is one of the most important questions you'll ever answer. And also one of the costliest to get wrong. Too many owners, they confuse burnout with readiness. They've had a tough year, their motivation's flat, and they think that means it's time to sell. Others hold on far too long, convinced they they'll know the perfect moment only to watch performance slide and buyers lose interest. Both paths can cost you hundreds of thousands, even millions of dollars. Today isn't about pushing you to sell or warning you to stay. It's about clarity. I want to help you understand the difference between being emotionally tired and being structurally ready and how both need to align for the best result. We'll unpack the signs that you're truly ready, the dangers of selling too early or even too late, and a self check framework to assess your own position right now. By the end, you'll know exactly where you stand and what to focus on so you can sell from strength, not exhaustion. Whether you're months away from an exit or even years out, this session will help you take control of the process and avoid one of the most expensive mistakes a business owner can make. So, before we dive in, let me share why I'm running this series. I've built and sold my own seven-figure businesses, and I know what it's like to be in the thick of it, the long hours, the risk, the emotional highs, and I tell you what, so many lows. Also, I know what it takes to prepare a business so buyers are lining up, not walking away. Today, I coach founders through that same process. I work alongside brokers, buyers, and owners who want to exit well, not in a fire sale, not in a panic, but in control. I see the deals that close quickly and profitably, and I also see the ones that collapse. It's rarely just about the numbers, it's about the whole story a business tells through its systems, its leadership, and how ready it is to thrive without the owner. So, this series exists because too many owners exit in chaos and regret. My mission is to give you the tools to avoid that, to help you sell from a position of strength with a business that commands attention and also premium offers. So, whether your sale is soon, whether it's years away, or just a maybe, these sessions will make sure that when the moment comes, you'll be ready to take it on your terms. All right, here's what we're going to cover in today's session. First, we'll look at the true signs you're ready to sell, not the emotional signals, but the tangible structural indicators buyers pay attention to. We'll then unpack how to separate fatigue from readiness. This is a critical distinction because burnout can fade the right changes, but readiness, it's built over time through things like systems, leadership depth, and a stable financial track record. Next, we'll explore why timing can outweigh price. You see, a business sold at its peak, even if the peak feels early, can often command a much better multiple than one sold later or with declining numbers. But we'll also cover the dangers of selling too soon when you're leaving growth potential on the table, and too late when buyers start smelling decline. And finally, I'll walk you through a self assessment every founder should do. It's designed to give you a clear, no nonsense view of whether your business or your team and your personal situation are all aligned for a successful exit. And by the end, you'll have a clear checklist and a framework to know exactly where you stand and the next steps to either close the gaps or take your business to market with confidence. All right. One of the biggest misconceptions I see from owners is confusing burnout with readiness. They're not the same, and mistaking one for the other can really cost you dearly. You see, burnout is emotional. It's the fatigue, the frustration, the sense that you've been carrying the weight for too long. It can be triggered by a rough quarter, a difficult hire, or just the grind catching up with you. But here's the thing, a burnout can fade, a break, a restructure, or better delegation can restore your energy and passion for the business. Readiness, on the other hand, This is structural. Now, it's not about how you feel this week or this quarter. It's about whether your business is genuinely positioned to thrive in the hands of a new owner. Are your financials strong? Are they clean? Are your systems documented and proven? Is your team capable of running without you in the day to day? You see, the problem is if you mistake burnout for readiness, you risk selling too early, handing over a business that still has untapped potential, which the buyer will enjoy instead of you. And if you think you're not ready because you're still energized, but the market and your numbers say otherwise, you could miss your best window. So, separating emotion from structure is the first step to making a smart, profitable exit decision. Now, when we talk about exit readiness, I want you to think of it in two layers. Firstly, there's emotional, and secondly, there's structural. Both matter, and both have to line up for you to get the best outcome. Emotional readiness, it's all about you, your energy, your excitement, your motivation to keep going. It's whether you still see yourself driving this business forward for the next few years, or if you're craving a new challenge. It's personal, and it's often what sparks the thought of selling in the first place. Structural readiness, this is about the business itself. It's the profitability trend over the past 3 years. It's whether your systems are documented, tested, and transferable. It's the depth of your leadership team and their ability to operate without you. It's your positioning in the market and how appealing that is to a buyer. The danger is leaning too heavily on one without the other. If you're emotionally ready, but the business is structurally weak, you'll either struggle to sell or you're going to accept a low offer. If the business is structurally strong, but you're not ready emotionally, you risk stalling the process. You're second guessing offers or even pulling out of deals at the last minute. A successful high value exit, it happens when both of you are aligned. And both of these two things, emotional and structural, are aligned. When you're personally ready to move on and the business is ready to stand on its own. All right, if you want a clear picture of whether your business is truly exit ready, there are 5 core drivers you need to look at. The first one is the financial stability in the 3-year trend. You see, buyers want predictable performance, strong, clean financials, showing steady or growing profits over 3 years. It builds confidence and it also justifies a higher multiple. Now, the second one is owner independence. If your business can't run without you, it's not really ready. A buyer doesn't want to purchase a job, they want to buy a self sustaining operation. The third one is documented systems and processes. Every key process should be documented. It should be repeatable and easy to hand over. This makes the transition smoother and reduces the buyer's perception of risk. And the fourth key readiness driver is clear growth story for the buyer. A buyer wants to know not just where the business has been, but where it can go. You need to show them opportunities for expansion they can capture after purchase. And the last of the 5 key readiness drivers is a solid marketing position. The strength of your brand, your reputation, and your competitive advantage, they all play a big role in valuation and buyer interest. And when all 5 of these are in place, you create an asset that's not just profitable today, but it's desirable for the long term. And that's when you know you've moved from just tired to truly ready to sell. So sometimes what feels like readiness is really just exhaustion. And if you sell based on that alone, you could be giving away your business's best years. So here are some signs you might be just tired and not truly ready. First, there's no clear step after the exit. If you can't picture what you'll do post sale, whether that's another venture, investing, or even a lifestyle shift, you might just be chasing the relief of getting out, not moving towards something you want. Second is the revenue is still climbing rapidly. This is often the worst time to sell unless there's a real strategic reason. Growth is when buyers see the most upside, and you should be capitalizing on that before handing it over. Now, the third sign that you're just tired, your role is still critical. If the business can't operate without you day to day, buyers will see risk and you'll see a lower valuation. And fourth, there's no succession plan in place. Without a clear transition path for leadership, you're essentially selling uncertainty, and uncertainty kills deals. And look, if any of these apply to you, it doesn't mean you can't sell. It means you may get a far better outcome by addressing them first. Sometimes the smartest move is to recharge, restructure, and then go to market from a position of strength. All right. Now, selling too soon can feel really tempting, especially if you're tired or if someone waves an offer in front of you. But the hidden costs, they can be huge. The first cost is a lower valuation multiple. If your business still is in growth phase, buyers will pay less for it now than they would once it's more mature, proven, and stable. The second cost is leaving growth potential for the buyer. This is where you hand over the keys just before the business hits its stride. And they're the ones who enjoy the bigger profits you work so hard to set up. It's like training for a marathon and letting someone else run the last kilometer to collect the medal. Now, the third cost is seller's remorse. I've seen so many owners, they regret a sale within 12 months because they realized they could have achieved more, not just financially, but in terms of legacy and satisfaction. And that feeling, tell you what, can linger for years. So the solution isn't to wait forever, but to time your sale so that you've captured enough of the upside while still leaving something attractive for the buyer. And the sweet spot is when you're handing over a strong, well positioned business that still has clear growth paths for its next owner. And look, even selling too soon can cost you. Waiting too long can be even more damaging. I've seen owners hold on well past their peak, thinking just one more year will add value. And instead, they end up chasing their decline. The first danger is declining performance. You see, even a small dip in revenue or profit, it can trigger alarm bells for a buyer. They'll question whether the downturn is temporary or a sign of a deeper problem, and they'll price into that risk. The second danger is a market shift. Changes in technology, regulation, or even consumer behavior can reduce demand for your business almost overnight. And by the time you react, the valuation gap can be significant. The third danger is buyer perception. If your numbers are sliding, buyers may assume they're buying damaged goods and either walk away or they're going to make a lowball offer. The lesson is this: your best window is when the business is healthy, the market is favorable, and you still have the energy to drive the process. Waiting too long can turn a premium sale into a salvage job. And that's a position that no owner wants to be in. All right, here we go. Here's a quick self-check I use with all of my clients to gauge exit readiness. These 4 questions can give you a brutally honest snapshot of where you stand. First, could you take a 3-month holiday tomorrow and have the business run smoothly without you? If the answer is no, your business is still dependent on you, and buyers will see that as a risk. Second, would a buyer say yes after seeing your very first information pack? That means your numbers, your positioning, and your story all look compelling right from the first touch point. And the third is your EBITDA, your profit. Is it stable or is it growing? Buyers pay for predictability. Declining profits, even if explainable, can weaken your position. And fourth, do you have a signed off transition plan? This really reassures buyers that the handover will be smooth and that they won't be left scrambling. Look, If you answered no to any of these, it doesn't mean that you can't sell. It means that you have clear areas to work on before going to market. Fixing these in advance can be the difference between a quick sale, a high value deal, and a drawn out, heavily negotiated one. Okay, one of the smartest things you can do is prepare for the exit while you're still engaged in the business. Too many owners, they wait until they're mentally checked out to start getting ready. And by then, their business is already losing momentum. First, you need to build your deal room early. This means gathering all the financials, the contract systems, the key documents, anything a buyer will want to see. And having it ready signals professionalism, and it also speeds up the due diligence process. Second is to strengthen your leadership team. You see, the more capable your managers are, the less dependent the business is on you, and the more confident a buyer will feel. And third, remove your name from any operational bottlenecks. If every decision or approval still runs through you, start delegating now, because buyers want systems. They don't want personalities that are running the show. And fourth, map out your ideal exit timeline. Even if it's years away, having a plan helps you align growth, personal readiness, and market timing. The goal is to make your business look and feel like it's already operating without you. That's when buyers see it as an asset that they can step into with minimal disruption. All right, here's your readiness action plan. If you're serious about selling and you want to sell well, you need a clear action plan, not just vague intentions. And here are the 4 steps that I recommend. First, complete an exit readiness audit. This gives you an objective scorecard of where you stand across financial, operational, and market factors. You can't fix what you haven't measured. Now, second, identify the gaps in the financials, the leadership, and the systems. These are the areas that can hold back your valuation or slow down the sale process. And prioritize closing these gaps now before you're under buyer scrutiny. And third, set your target valuation range. This isn't about wishful thinking. It's about knowing what's realistic based on your industry, your performance, and comparable sales. That number becomes your benchmark. And fourth, decide your non-negotiables for a deal. These might include price, payment structure, the buyer's intentions for the team, or your post-sale involvement. Knowing that these upfront helps you stay firm when negotiations get emotional. I'll tell you what, they will get emotional. A clear action plan turns, well, you know what, I think I'm ready, into I know I'm ready. And that's the kind of confidence that buyers respect and they also pay for. All right. By now, you should really have a much clearer picture of whether you're truly exit ready or just feeling the weight of ownership. The next step is to take action on what you've learned. If you want a personalized view, all you have to do is simply book a one-on-one exit readiness audit with me. Head to sampenny.com/chat. We'll go through your business in detail, score it against the key readiness drivers, and map out the fastest path to a stronger sale position. Second, tap into more real-world insights by listening to the Built to Sell, Built to Buy podcast. You're going to hear from owners, brokers, and buyers who've navigated the same decisions you're facing, so you can learn from their wins and also their mistakes. And finally, download the Business Sale Readiness Report. It's a free tool. It benchmarks your business against what buyers are really looking for. Sometimes seeing the score in black and white, it's the push you need to start closing the gaps. And the sooner you start preparing, the more options you're going to have, the better your sale outcome will be. So honestly, don't wait until you're tired before you get ready. Okay, before we wrap up, let's look ahead to our next session. It's called Unlocking Value in Your IP, your brand, and your customer data. And this one always is a game changer for many owners. Most people think the value of their business is tied almost entirely to revenue and profit. While those numbers do matter, these are the hidden assets inside your business that can dramatically influence your valuation if you know how to identify and present them. We're going to break down how to assess and package your intellectual property, your IP, so buyers see it as a long term advantage, not just a nice to have. We'll explore how your brand equity, the goodwill, the reputation, and the trust you've built can be quantified and leveraged in negotiations. And we'll also cover how your customer data can become a premium asset when it's well organized. And we have to make it GDPR compliant, and it shows deep engagement. So if you've ever wondered how some businesses sell for multiples that they seem way above the industry average, these hidden value drivers are often the reason. This is about turning what you already own into a powerful selling point that justifies a higher price. Trust me, you won't want to miss it. I'm Sam Penny. This is Built to Sell, Built to Buy. Hope you enjoyed it. Go out, build strong, be brave.